A large number of traders still cannot understand what a block order is and why a price reaction should occur from it. Why is its correct definition so important when trading in financial markets? How to determine it, and why not all order blocks are processed? There are a lot of questions about blocks. Let's start understanding this topic. A block order is nothing more than price manipulation, which removes liquidity, thereby collecting stop orders from many traders. Have you ever had a situation where you saw a beautiful block order, entered the market from it, but the price removes your stop loss, turns around, and goes in the direction you predicted? This doesn't mean that block orders don't work. It's just that you don't know how to determine a valid block order. Before I started using order blocks in my trading, I conducted a huge backtest to understand and select for myself the most relevant options for their formation, with a high percentage of processing. Before we continue, I want to ask you to subscribe to my channel so as not to miss the release of new videos. According to YouTube statistics, 92% of people watch my videos without subscribing to the Pips Li Trade channel, and this greatly upsets me. Your subscription and activity in the form of comments and likes encourages me to create more useful and interesting content for you. I'm sure you subscribed and liked it. Well, we continue. 4 rules that I have defined for myself. First, liquidity withdrawal is one of the most important rules for creating a block order. The collection of liquidity is the trace of a major player who carried out this manipulation. This means that in the future, when the price approaches this order block, it will protect this zone, gaining its position for a price reversal. Second, before the order block, ineffective pricing in the form of an imbalance must be formed. What is an imbalance? I will tell you in more detail in another video. Third, understand that a block order is not a pattern. This is not a support level or a resistance level or any of the types of chart patterns. The block order is based on a logical understanding of the formation of price action. Fourth, a block order should be considered on higher time frames, starting from 1 hour and above. This does not mean that they are not on lower time frames. They certainly are there. They just need to be used to find entry points into the market. Quite simply, on higher time frames, we use order blocks to search for a global price reversal, and on lower time frames, we use them for the zone from which we will consider the entry point. So, what is a block order? It can be compared to the easy money button. Just click on it, and bills will fall on you straight from the sky. Are you dreaming? Then let's continue. A block order is a zone in the form of a candle or bar that blocks the orders of other market participants. On the screen, you see a chart pattern of double tops or equal highs. This is also a resistance level. Above the level are stop losses of seller traders who trade levels and graphic patterns. The market maker also plans to sell from these zones, but since everyone is selling, he needs to create a situation so that traders buy. To do this, he simply breaks the resistance level with an impulse movement and turns it into a support level, removing sellers and provoking everyone to open purchases. It is these buy orders that the market maker blocks by placing his sell orders. Then the price impulse falls beyond the level, creating an imbalance which will be blocked in the future. How is imbalance created? A market maker is a counterparty who undertakes to fulfill your order to sell, even if there was no buyer at that price. When the price falls impulsively, everyone wants to sell, and believe me, when it falls, few people want to buy. Since the market maker undertakes to sell to you during a fall, he will need to return the price back to that zone in order to find a buyer and thereby cover his losses by rebalancing this price area. How to find a valid order block? As I said earlier, the price should remove liquidity and show its direction. What does it mean? There are several liquidity options, which, by the way, I already talked about on my channel. Therefore, I recommend that you watch it in order to better understand all types of liquidity and the logic of their formation. Having tested many variations of order blocks, I came to the conclusion that, for me personally, order blocks that remove liquidity from local and global highs or lows of price structures are more understandable and interesting than those that are formed within the structure. Why? The answer is simple. If you select all the blocks that are inside the structure, then try to guess which of them will stop the price and reverse it, and which will not. Yes, you can use the discount or premium zone for filtering. This is certainly true, but try to logically explain why this block worked and this one didn't. This is the task. The same cannot be said with blocks that form a false breakout. Today, the discussion of the smart money strategy is simply off the charts, and accordingly, major players know about it. Therefore, they began to create more false order blocks, make more complex false breakouts, and form not only a sweep, but also a resweep of levels. The more popular smart money is, the more sophisticated the market becomes. Local liquidity. Local liquidity is the levels of hourly time frames, which can be formed both at the minimums or maximums of previous days and within the day, acting as a rule as the liquidity of previous sessions. When the price removes liquidity from the level and returns back beyond the level, I switch to a 5-minute or 15-minute time frame and look at the price pattern. 1. Was there a breakdown of the structure? 2. I look for the presence of an imbalance. 3. Formation of the correct order block. In smart money, it is called an IFC candle. If all the criteria match, only then do I mark the block order and wait for the price to be returned to make a decision. I measure a stop loss, see where I can set a take profit, and if the risk to profit ratio suits me, then only then do I open a deal. Global liquidity. Global liquidity is the levels of daily or weekly time frames. It is formed on candlestick swings, or as they are called in smart money, correct rollbacks. How to mark the correct pullbacks? See my video, Market Structure. For global liquidity, absolutely the same criteria are used to find an entry point, but the risk to reward ratio is completely different. These deals don't come around very often, but they're worth it. One such transaction can bring significant profit, provided that you manage to sit until take profit. The second version of the block order that I use is formed on the continuation of the local trend. It is also divided into two subspecies. The first is inducement, or in other words, motivation. The price removes liquidity from the nearest structure, which is perceived by many traders as a breakdown of the structure. Then the price continues its local movement, forming a boss, thus forming a flow order. So that you understand, a flow order on 15 minutes is a block order on a higher time frame. For example, 1 century, we select the zone we are interested in, note the imbalance in it, and wait for the price to return to this area. Next, go to the lower time frame and watch the formation of a pattern or candlestick model. We set stop loss for a block of orders. The second option is the formation of a 3-wave or 5-wave correction. We wait for it to end in the form of choch and mark the flow order zone. You can enter both on a retest of the zone and on a lower time frame and wait for the formation of a pattern. We set stop loss for a block of orders. A block order is a very powerful tool in the financial market that can be used for profitable trading. But it is advisable to draw up a checklist with clear rules that you have selected for your type of trading and open transactions strictly according to them. I repeat that there is no strategy or pattern on the market that will give 100% profitable performance. Traders make money only through the risk to reward ratio. Look at the picture. Please note that you do not need to make 100% winning trades to be successful. You can be successful with 30% profitable trades. The main thing is to control yourself and stop thoughtlessly entering the market. And that's all. Good luck to everyone and have more profitable days.